Kia ora, good morning and a warm welcome to our September 2021 Beyond Economic and Labour webinar. Thank you for joining myself, Liza Viz, and our Beyond Recruitment team as we launch our 2021 Labour Survey and Salary Guideline. It gives me great pleasure to be hosting this webinar together with our guest speaker and partner, Shamubeel Eaqub. After a busy 6 months where we were enjoying the freedom of a virus-free community, we have all again been reminded, and rather abruptly over the last 3 weeks, that this virus has and will continue to have a profound impact. I wanted to thank you for participating in our annual survey. We heard from over 300 organisations up and down New Zealand, representing a wide range of business sizes and industry sectors. I'd like now to share some of our key findings and snippets of information from our webinar. 2021 was the first year since 2017 that organisations found the current economy easier to thrive in. 40% of employers believe the Fair Pay Agreements Bill will not impact their business, but that the country will be worse off for it. 60% of our respondents said their workforce grew in the past 12 months. At the time of the survey, 68% of our respondents expected to grow again in the coming 12 months. But I guess at this point, the impact of the latest lockdowns aren't quite clear to employers. 61% of employers said they are not satisfied with the quality and suitability of local talent, and they state finding talent being the biggest recruitment issue in New Zealand, and in fact that it has got worse since 2020. 81% of employers are more concerned about skilled Kiwis leaving the country and not returning. Employers say they have not seen the effects of a Kiwi brain gain. 52% of companies said that they're not using remote workers to fill skills gaps, despite struggling to find skilled talent, which is interesting. Retaining talent is considered a greater issue than attracting talent, and respondents feel it is harder than 12 months ago to retain staff. Employee well-being is now a top priority for dealing with staff engagement issues, and employee assistance programs, health and wellness initiatives, and stress management programs have all grown in popularity as one way of retaining staff. 74% of employers said that lockdowns have changed their remote working expectations. And times have changed, that's for sure. 57% of employers, however, are not offering flexibility in work hours and are less open to different hours of work. Work from home has led to digital collaboration tools, staff feedback surveys, and instant messaging, chat platforms as popular means to maintain company culture and cohesion in our new normal. So that's a little snippet of our key findings. A detailed report from the survey, together with our updated 2021 salary guideline, will be available to you straight after this webinar. Just a few housekeeping things to note before I hand over to Shamubeel. The webinar will finish at approximately 12 noon. We will leave about 10 minutes prior to this finish time for a Q&A. You do have the opportunity to send your questions throughout the session and on this link. There is a Q&A function on the right-hand side of your screen. We'll be collating these questions throughout the presentation, and I will present the key themes of your combined questions to Shamubeel at the end of his presentation. It now gives me great pleasure to hand over to Shamubeel Eaqub. Shamubeel needs no introduction. He is one of New Zealand's most prominent and highly regarded independent senior economists and provides economic consulting to senior leaders across the public and private sectors through his company, Sense Partners. This morning, Shamubeel will be sharing real-time insights on the impact of traversing in and beyond the COVID-19 pandemic and what it means to our economy and to business. Welcome, Shamubeel.
Thank you, Liza. It feels quite strange to be doing yet another Beyond webinar in the middle of a lockdown like we did last year. But we've learned so much since that time. When the pandemic first hit, it was very hard for us to see what would happen within it and beyond it. And while the pandemic still has some time to run, I think we need to really start planning for what happens next, particularly from a labor perspective, just because we are facing so much demand and scarcity for good skills and good talent. So the big messages I really want to get across to you today is, first, the disruptions that we are facing because of the pandemic are not going to go away. What we're seeing with Delta in places like Australia or even in the lockdown in New Zealand, these are things that are affecting the world because vaccination rates are so low outside of the rich countries. The reality is that these disruptions are not going to go away. COVID is going to become endemic. It is going to become normal to have COVID in the community, and that will mean some level of restrictions and some level of changes of behavior that will be needed in the future. Now, even though we've had massive disruptions, the reality is the economy is actually in pretty good shape if you haven't been in those extremely affected industries. So tourism, some of those tourism-specific industries and locations have been hit really, really hard. But outside of that, the overall economy is doing pretty well. Now, one of the big risks that I see going forward, at least for the next 6 to 12 months, is the shocks from global supply chains. We're seeing the spread of Delta through places like Vietnam and Malaysia is affecting factory production, is shutting down ports, shutting down activity, and we're going to see continued disruption through the supply chain and through the global economy for some time. It might affect your Christmas presents. But at the same time, in New Zealand, while we've had yet another lockdown, we are probably better placed than most because our economy has been relatively free for a long period of time, and our policymakers, particularly our government, still has room to provide stimulus. As you saw with the lockdown, as soon as the lockdowns were introduced, we knew what sort of policy tools would work, and they were unleashed relatively quickly. And that will continue to be the case for some time. Now, when I look forward, what I see is the theme of the last 12 months is going to go on steroids. With the labor shortages that we're facing is because our economy is growing. There are not that many people who are actively looking for work. The pool has shrunk, and those pressures are going to intensify, both because the borders are closed and also because when you look forward, we know that immigration policy is not going to be free like it was pre-COVID, I don't think, ever again. And we know that lots of New Zealanders will want to go and do their OE and live overseas. So there's going to be a huge amount of pressure on the labor market. So we're going to have to start planning really, really hard for what happens if the labor shortages that we're facing now get even harder over the coming years. So what we need, I think, is very much about a long-term plan that starts from first principles. What tasks do we need to do? What attributes of people do we need? What skills do we need? How can we invest in the right people in the right ways? Do we have the right job sizing? We got to go through the whole plan of how we do our business, because the reality is we simply cannot assume that we will just be able to hire to how we do business today. We are going to have to think very hard about thinking differently about doing our business. And we also have to think about recruiting with a lot of training and a lot of investment. And we have to be willing to pay higher pay, and we have to be willing to meet our workers on their demands for work and career options that they're looking for. So there are lots of things I think for us to think about. Some of it is quite short term, which is the disruption, and also the long-term stuff where I think we're going to see some really big pressures around how the economy is going to unfold and how it's going to impact on our availability of labor. Now, I'm absolutely convinced the disruption that we're seeing today is not something that is going to disappear very quickly. Now, we had some hopes when the pandemic first hit that with the vaccination program, we would eventually get on top of it. But what we're seeing is that even with the vaccination, we know that the immunity will fade. We'll need continuous increases in vaccinations. But the bigger concern is so much of the poor world in particular is unvaccinated that we continue to see this spread of new variants, like we're seeing with Delta right now. Now, having said that, what we have seen is in New Zealand, we've had a pretty good response. Now, while in many countries that we normally look to the number of cases and the number of deaths has been just extraordinary, in New Zealand, we barely kind of rate a mention when you look at the charts. Right at the bottom corner, you can see Australia and New Zealand creeping up with Delta just in the last few months. But in comparison, many other countries have been through many months, over a year of infections, deaths, and pain, and lots of restrictions, which we haven't had except for some very short, sharp periods. And I think this is one of the things that is missed by a lot of folk, that, you know, people think that if we reduce our restrictions, things will go back to normal. In fact, what we can see from around the world is rather than going back to normal, most countries are running some sort of relatively restricted kind of lifestyle. And that means that the way that people are able to move, whether they're able to go to work, and whether they're fearful of going out, all those things affect behavior and the economy. And essentially what you can see in this chart is when the pandemic first hit, in that sort of maroon line, New Zealand just locks down really, really hard. And we get this essentially the complete shutdown of most parts of the economy outside of essential workers and those who can work from home. And then we open up quite quickly. And when it opens up, we saw this massive rebound in the economy outside of essentially those businesses that are affected by the border. And we went through this a few times, but if you compare to pretty much every other country, what we saw was that our cumulative restrictions, or the average restrictions since the pandemic started in New Zealand, was the lowest of the OECD countries. And this means that we've been able to just go out there and do things. By and large, we haven't been fearful of going to shops or going on a plane or going on holidays. And even in tourism, we've seen that those, especially those domestically focused regions, have done pretty well. So Queenstown still got hit pretty hard, those internationally focused areas, but places like Taupo or Coromandel or even Gisborne, they've been booming because domestic tourism has been up so much because people can't go overseas. Now, to give you a little bit of context around what this lower level of restrictions mean, this short and sharp, very hard lockdowns, has given us way better outcomes. So compared to Sweden, which is kind of the control case, because they took a very different approach, doesn't matter what we think of it, the comparisons I think are really useful. As of today, we have 36,000 fewer unemployed than if we had followed the Sweden experience. Our GDP is $15 billion higher. We have had 7,300 fewer deaths. You know, and if you put a dollar figure in, which I think is a little bit grim, but is somewhere between 4 billion and 36 billion, depending on how you value it. And really what we experience in most countries around the world is those restrictions mean that people aren't able to do normal things. And it's normal things that make up the economy. It's our interactions, our ability to connect with each other, being able to travel, being able to do things. That's really what the economy is. When those restrictions are there, even at a moderate level for a long period of time, they're much worse than having short, sharp restrictions that are followed by essentially relative freedom. Now, eventually we won't be able to keep doing this forever. And that's because what we're going to find is as vaccination rates increase, we're going to find a lot less social acceptance for people being restricted in the way that we have been. And so we are going to have to evolve our responses. So I don't think that's going to happen for a little while. I mean, realistically, our vaccine rollout has been slower than most other rich countries. And we're probably not going to have full vaccination, whatever that may be, until early part of next year. When that happens, we're going to see some changes in government's response in terms of how it does things. But we won't be able to open up fully. That's because Delta is still extremely vicious, and there will still be a large chunk of New Zealanders, including children, who will not be vaccinated. So the risk remains, and our health system, and particularly our ICUs, they are just simply not set up for the kinds of volumes that we might get. The kind of overrun hospitals that they're expecting in places like Sydney is simply not something that I think most New Zealanders will want to countenance, especially once kids start dying. So we shouldn't expect a return to normal, but that doesn't mean the economy is going to be terrible. The reality is that what we have seen over the last 12 months is, yes, we have had enormous shocks, but we've also seen enormous policy responses and enormous adaptation and flexibility by businesses and by people. And as a result, we've seen our economy doing really quite well, much better than we expected when the pandemic first hit, and much better than most of our peers, global peers, when it comes to how it's been panning out. And I think the easiest ways to see this is to look at what's been happening with jobs. So when you have a big economic shock, we tend to see job losses, which is kind of normal, right? Because businesses will shed staff and they'll want to preserve as much of the cash as possible. And also because there's less demand. And so if you look on the left-hand chart, there's the number of people who are employed, and you can see through the middle of the chart, that big dip, that's what happened during the global financial crisis. So we lost enormous number of jobs, and it took us nearly 4.5 years to recover back to where we started from. If you fast forward to today, what you can see is there's just a bit of a blip in job losses in that sort of first half of the year. So through the June quarter and the September quarter, when we had job losses in New Zealand. But by December, we had recovered back to where we were pre-pandemic. And since then, the number of jobs has been increasing. And you can see that on the right-hand side, pretty much for the last 4 quarters up to June, we've seen consistent growth in jobs. So we might get a bit of a blip because of the lockdown, but realistically, what we're seeing is businesses know how to deal with lockdowns. They know that it's very hard to find labor. So they're really loath to let go people if they're only going to have to rehire them when demand comes back once the restrictions are lifted, which has very much been the experience of the last little while. Now, while we've had employment growth, I think it's important not to gloss over the fact that there has been an enormous amount of pain in many parts of the country, in many industries, and many people have lost their jobs. The places where the job gains have been and where the job losses have been are not the same. And this map gives you, I think, a good feel for where the job gains have been and where the job losses have been. So all the red sort of splotches are districts where jobs have gone backwards, and all the blue areas are where jobs have gone up. And you can see that in the North Island, through the center of the North Island, there's been quite a big impact in terms of jobs. And we've also seen quite a lot of job losses in Northland, Auckland, and Tauranga. And that's because of the type of economies we have. And then you look at on the South Island, where the tourism impact has been just devastating for so many of our communities, particularly in places like Queenstown and Mackenzie District, where a huge part of the economy was entirely dependent on international tourism. So these are not surprising, but I think we have to be alive to the fact that even when we're seeing these macro numbers that say the economy is doing well, it's true, but the winners and losers are not the same. And the share of the wins are uneven across our country. Now, what we see also is that the rebound has been pretty strong. So on the left-hand side, you can see consumer spending until we had the latest lockdowns had been very strong. So consumer spending was growing at a really fast clip. And part of it was because people got a little bit scared and a little bit cautious late last year. But then once sort of we came out on this side of the year, we saw pretty good spending coming through, and people are spending money on everything, right? Including on things like furniture, furnishings, because the housing market's booming. By and large, we're seeing pretty good spending growth across the economy. With the lockdown, of course, we won't be able to have our coffees and doing those other things, but make no mistake, once the thing opens up again, we're going to see people going out to spend again. One of the things that we were really frightened of is what would happen with the disruption in terms of the number of businesses that are out there. How many will be too scared to start new businesses, and how many will close their businesses? On the right-hand side, you can see what's happened in the last 12 months is we actually didn't have a big increase in business exits or business deaths. And we didn't have a big slump in the number of new businesses that were being started. So surprisingly, despite all the disruptions of the pandemic, we haven't actually seen that entrepreneurial spirit being crushed. So again, there is this kind of big divergence across industries and regions, but overall, what we're seeing is there is actually quite a lot of entrepreneurial zeal that's still in the economy. So there is still some risk taking. There is still that kind of movement of people trying out new ideas. And as we know, with disruption comes the opportunity to try new things. So when we look at other things like insolvencies and bankruptcies, those numbers are at record lows. So there is pain out there, but it is not nearly like we had seen it during the global financial crisis in the recession 10 years ago. If anything, we're probably in more normal economic times than we would expect. And that's kind of what we saw so globally as well. So, when the pandemic first hit, you can see on the left-hand side chart, the global PMI, which is the sort of the best indicator of manufacturing activity globally, that just stopped very sharply, right? Because factories were closed, ports were closed, there were massive bottlenecks. But then it rebounded very strongly. Just in the last couple of months, we have seen some of that turning around. So in places like Vietnam, Malaysia, Thailand, parts of China, we've seen factory closures and those bottlenecks coming back because of Delta. So we should expect some pressures coming back. So this volatility because of the pandemic is definitely there, but we also know once you get on top of it, things will rebound pretty quickly. It has some big implications. One is that when it comes to our ability to get products from the manufacturers of the world, it is going to be hard. When it comes to getting space on ships, little alone New Zealand is really going to struggle. And that's what you can see on the right-hand side. The cost of shipping has absolutely skyrocketed over the course of the last couple of years, and that is not going down anytime soon. It's just the whole global supply chain has become really, really disturbed, and we should expect it hard to get access to containers. We should find it hard to get capacity. And as a result, what it means is not only will we face supply chain shocks when it comes to buying stuff from overseas, but also when it comes to selling our things, it is going to be very expensive and quite difficult to get it away. So we're not out of the woods. There are still risks, but they're manageable risks if we know where they're coming from. And these supply chain disruptions, while they were quite important, it's also important to recognize that we came out of it, that they will come back and we will rebound. So it creates this uncertainty, very different to what we had in pretty much the decades leading up to the pandemic, where just in time meant if you wanted something in Christmas, you just ordered it and you knew it would just turn up. That kind of certainty of delivery and supply chain resilience is simply not there. And what we saw was, if you look on the left-hand chart, that's on that blue line is inputs for businesses, so things that we buy to sell to others. And the red line is the stuff that we buy to consume. And you can see both of those things had a big fall in 2020 when the pandemic hit, but they've all rebounded pretty quickly. But even despite the big rebound, by and large, we haven't made up for that big hole that we had during the initial disruption. And what we're seeing is across many parts of the economy, not every part, that inventory levels are running really low. So businesses are just running out of stuff. And things like if you've tried to buy a new car or a new washing machine or kitchen stuff or nails for particular types of activities, we just don't have the stock. And so that's what you can see on the right-hand side. In the blue bar is how much inventory we have of various types of retail products. And the red line is how much lower it is compared to middle of 2019 before the pandemic. And in a lot of industries, what we're finding is, particularly if you're looking at household furnishings, furniture, and those kinds of things, because most of that is important, those supply chain shocks have just meant that things just are not here. So you're not able to buy it. Now, there's a bunch of implications for it, but it's very unusual for us to live in this kind of thing, this environment, because we've been used to essentially getting access to whatever we wanted. If you want something, you pay for it and it turns up. But now we're being subject to this strange thing of rationing because we simply cannot get access to products because it's not here. So I was talking to one of my mates who works for a car dealer, and he was saying, well, there's a wait list of several months for certain models because you know what? We just can't get a hold of enough stock. So we are going to see these kinds of disruptions, and that is going to mean a few things. One is we're not going to be able to buy things when we want them. But two, it might mean that we're going to see some cost increases or price increases for a bunch of stuff. So it is likely to be inflationary. While it is likely to be inflationary, I don't think it's going to be widespread. So not every industry is able to kind of raise prices just because the costs have gone up. And what we're seeing is across the economy, these are slightly geeky charts, but I quite like them. Essentially what they're saying on the left-hand side is across the economy, the amount of sales by businesses in New Zealand has gone up a lot, by about $6 billion in the first quarter of this year compared to last. But the inputs have also gone up by a similar amount, but their gross profit margins are going up. But cost of salaries have gone up as well. As a result, their profits have fallen. So there is a bit of a pressure that's coming on businesses to raise prices. But that is very localized and focused in just a few industries. So it is very much focused on essentially what we're seeing in the tourism industry. They are struggling massively. But in the rest of the economy, like for example in retail, what we have seen is yes, costs have gone up, but profit margins have also gone up. So they're still keeping pace with the increase in costs. And while salaries have increased a little bit, they haven't been enough to really dent into their profits. So there is still quite a lot of fat in the system where many businesses have in fact increased their profit margins in the last year or so. So I don't think we should expect that the Reserve Bank should raise interest rates just because we're seeing some of these cost increases coming through from overseas events and short-term disruptions. But having said that, you might have noticed that all the bank economists are out there going, oh, we must raise interest rates right now, otherwise inflation is going to be a bit of a problem. And it's true, inflation has spiked up, but a lot of that is very temporary and very transient. We're not seeing kind of widespread increases in cost pressures and price pressures yet. And what we're seeing, particularly if you think about our domestic economy, where most of the inflation comes from, is from wage increases. Now, wage increases are happening, but they're not at the level where we should be worried yet. So if you look at what's happening on the right-hand side, our wage inflation is running at just over 2%. And if you look at the experience of the 2000s, the mid-2000s, wage inflation got way up to 3 to 4%. And realistically, given the balance of risks that we face, that yes, there is a little bit of inflation, but it might be transitory. And there might be lots of global disruptions. And there is a pandemic that's still raging out in the world. It seems very surprising to me that we would want to raise interest rates in this environment when all these risks are still out there. Now, a lot of the reason why we had a very resilient economy in the last 12 to 18 months is not just because of that kind of monetary stimulus, because the Reserve Bank cut interest rates and those kinds of things. That helped, but really the big thing that helped was the government spending that was just so big. And you can see on the left-hand side, the amount of money that was injected in the economy is just extraordinary. In 2020, we injected something like 7% of the economy as fiscal stimulus, which is massive. Not surprising, right? Because we essentially shut the economy down for a while. The first lot of wage subsidies was huge. And that was really quite important because that subsidy, that money was critical for our public health response. It meant that people didn't have to go to work under stress and duress. It meant that businesses didn't have to try and stay open. It meant that jobs weren't lost. So many viable businesses and jobs were preserved because of those huge stimulus that we saw in 2020. And we'll see that continue for another 1 or 2 years, and that is going to be helpful. That means government keeps pumping up the economy, and that stimulus has been really quite important. On the other hand, the stimulus that we saw from the Reserve Bank was by and large misspent. Most of that increase in stimulus, or very low interest rates and increase in lending, went towards buying and selling second-hand houses. The amount of lending to farms and businesses actually fell. So the reason why we want to inflate or to catalyze the economy through interest rates is because we want more businesses to borrow, more businesses to invest, and we want that to create long-term future economic growth and jobs. But we haven't seen that. What we have seen is businesses by and large have been a bit cautious about taking on debt, and banks have been quite cautious about lending as well. But people haven't been cautious about borrowing tons and tons of money. And you can see the impact on the left-hand side. House prices have gone up by nearly 30% since the beginning of the pandemic. I had to extend the axis on my chart because house prices have gone up so much that relative to incomes, they're now at a new record high. And not only that, if you look on the right-hand side, you can see that as of today, house prices are over 5% of 5 times of household incomes across many parts of the country. All those red shaded areas are places where house prices have become extremely unaffordable. Now, it means that it's getting harder and harder for us to find places where non-homeowners can afford to live in those communities. So many parts of New Zealand are becoming hostile to their citizens. So it used to be just a few places 10, 15 years ago, it used to be Queenstown and Auckland that was really hard. But fast forward to today, it is pretty much all parts of New Zealand. So it is getting really quite difficult for us to find places that are affordable to live and to do business. So this is going to be one of those big challenges. The reason I said the Reserve Bank is sidelined is because it has done so much in terms of monetary stimulus because it was the right intent. They wanted to protect the economy. They wanted to protect their financial system. But what they have done is they have worsened the existing inequalities and existing problems that we had. The very high house prices, unaffordability, all those things have just compounded. So here is an organization that sits there essentially as unelected representatives trying to manage the economy. And arguably, you'd say that monetary policy has run its course. On the other side, there's quite a lot of concern that the government has borrowed a ton of money to support the economy. How much more can they do? And isn't it going to make us all bankrupt like it did in the 1980s? And the answer is yes, we've borrowed a lot of money, but actually not as much as people think. And also, it's not the amount of money that you borrow, it's the cost of servicing it that is probably the most immediate threat. On the left-hand side, it's almost a 100-year chart of how much debt we have, government debt we have relative to taxes. And you can see that it has increased, but it's still going to be below the kinds of levels we had in the 1980s, in the peak of the 1980s. The key difference, of course, is that unlike the 1980s, the interest rates now are just so low that the cost of servicing that debt is very, very low. So we're going to spend less than 5% of our tax revenue on servicing our debt. And what that means is, unlike what happened in the late 80s, when almost a quarter of our tax revenue was being spent on just servicing the debt, that meant that we had very little money left over for all the other public programs that governments and public want money spent on. In comparison, because of extremely low interest rates, what we're finding is actually the cost of debt is very, very low. Debt is not going to present a significant barrier for us to be able to do the services that we want. And that is a good thing. It means that not only can we afford to keep supporting the economy, if the need arises, the government will be able to do more. As we're seeing right now that we have kind of spent the earmarked money that we had anticipated at the beginning of the pandemic, but there is actually no kind of end to how much support the government can give. We can keep borrowing as long as it's being spent in the right way for the right reasons. And like I said before, the incentives and the expenditure and the support that we have seen have given better outcomes than the alternative. So compared to Sweden, our economy is $15 billion bigger, and we are up 7,500 people relative to Sweden, right? So there are some pretty good ways for us to sort of think about why it might be worthwhile doing this. But we're also in a very new era. It is extremely, I think it's very hard for people to see that we are making this kind of shift to a different way of doing things. So pretty much since the 1980s, the Reserve Bank has been the key economic manager. So what the Reserve Bank did in terms of interest rates, what cryptic things it said in its communications was very, very important for people to stay on top of. Now, my sort of sense is that it doesn't really matter what the Reserve Bank does right now, because it's a much smaller part of the policy fabric than it used to be. And that's because interest rates are now so low that small changes from here are not going to make a huge amount of a difference. And it has become increasingly politicized. So essentially, many of its functions are now being taken over by the beehive rather than what the Reserve Bank used to do, which was essentially a bunch of technocrats doing what they felt like within the constraints that were set in the law. but their role has become very asymmetric. So because we have just so much debt in the economy, particularly for households on mortgages, that even small increases in interest rates will have a really big impact on people's cash flows and the economy. But when it comes to lowering interest rates, it doesn't have the same kind of same kind of stimulatory effect, because interest rates are already very low and people have kind of borrowed up to their gunnels to borrow lots of money and spend, but they can't really do much more. It feels to me like the Reserve Bank has become relatively impotent against preventing recessions. Their job is now much more the domain of the government. Now, as we saw in the last 18 months, when the Reserve Bank moves really hard, it knows how to inflate the housing market, but it doesn't know how to inflate the economy. The government is probably going to dominate in this. So we saw the fiscal policy, massive amount of new cash that was injected into the economy, and that was pretty successful. And it became much more interventionist. And it's going to get a taste of it, not just in New Zealand. Around the world, we're seeing governments, by and large, being much more interventionist, much more interested in how they can move needles and levers, because they want to be able to create good outcomes or meet their political ends. So whatever the reasons might be, we are seeing some big changes in the way that government is going to act going forward. In places like the US, we're seeing the Biden government essentially becoming much more of what the America used to be like, which is very much an interventionist government with things like industrial policy, very kind of focused around protecting American jobs and American businesses. And we're going to see a return of that. And that means that governments are going to become the key economic manager, and you need to be cognizant of that. For your industry, for our country as a whole, we know that the power has shifted towards a more muscular government. So Beehive is far more important than it has been in the past. So if you're not interested in politics, I suggest that it becomes a bigger interest for you. Now, by and large, I think we can assume that the economy is going to rebound after the lockdown. By and large, we can assume that there will be stimulus for at least another year to 2 years. We can assume that the economy will be in relatively good shape because businesses know how to deal with these kinds of things. But if the economy is growing, for us to be able to, I guess, take advantage of that as businesses, we have to have more people and more capital to be able to sell more stuff and make more money. One of the biggest difficulties that we've seen in the last 12 months is you might want to hire more people, but it's hard. It's become harder and harder. And that's because while we've had people who've lost jobs, that easy access to labor that we've had for many decades, which is through the open border and immigration, that's just shut down with the closed borders. Now, I've been telling you guys in this Beyond webinars and presentations for the last few years that do not expect immigration policy to stay the same. We should expect that immigration policy will flip from getting nearly 100,000 people coming in every year into New Zealand. We are not going to see that, I don't think, ever again. That kind of free and open immigration policy is coming to an end. And that means the labor shortages that we're seeing today are going to intensify. And we can kind of see what's going on. So you can see on the left-hand side, the official kind of unemployment, the number of people that are unemployed is back down to where we were before the recession. When it comes to the number of people who are registered unemployed with MSD, those numbers have come back, but they're still up around 50,000 from before the pandemic. So there is some pockets of labor still out there, but by and large, they are quite mismatched. So either they're in the wrong places or they're in the wrong skills and wrong industries. And that's part of the reason why we're finding such a big difficulty in getting access to labor. But also what we can see on the right-hand side is the number of vacancies or the job ads that we're seeing out there has just absolutely skyrocketed. It's gone vertical. So I don't think we've ever seen such a frenzy for new workers, for labor. And so businesses want to hire more people. So we shed a few people through the recession, through the pandemic start. But really what the characteristic of the last 12 months has been, I really, really need more people and I can't get access to it. And if you look at where the demand has come from, by and large, the demand is actually coming from the provinces and the traditional sectors. So on the left-hand side, you can see that in terms of job ads, Auckland and Wellington are down a bit, and pretty much all the other parts of New Zealand are up. And that kind of makes sense because a lot of the really strong demand for labor is coming from those more traditional sectors, industries. So the primary sector, which you can see on the right-hand side at the bottom, manufacturing, logistics, and of course, because the housing boom, real estate. So very, very strong growth in a lot of those relatively traditional sectors of the economy, but not as much when it comes to things like admin and business support, which is dominated by things like travel agents and those kinds of things, but also back office services. Retail and hospitality, which is very highly concentrated in the urban cores, and of course, professional services. So what we're seeing is that it's been very much economic recovery and a demand for labor that is a bit more old school than what we've been used to in recent years, which is much more towards that more professional end of town and more urban parts of New Zealand. And this kind of makes sense because when you think about the provincial economies, the lockdowns and those disruptions have actually been not much of a thing for them. They have many more essential industries, the economies are pretty strong, and what we're seeing is that those places are in pretty good position. So we are going to see this divergent impact of where the demand is going to come from and where the shortages are. So in a lot of these provincial places, we don't have a deep pool of, available talent, and that makes it really hard to find workers. As a consequence, what we've seen is businesses are doing more with less. And so if you look on the left-hand side, that's the amount of GDP per hour worked in New Zealand. And essentially, we had seen a flattening of that for about 10 years. So there was almost no productivity gain in our businesses for 10 years. And then boom, suddenly the pandemic happened. It fell very sharply because no one was able to go to work. And then since then, we have really come up really quite high. So we're squeezing a lot more out of the workers that we do have. And a lot of those big increases are coming from right across the economy. And it's very encouraging to see across, logistics and professional services, hospitality, construction, manufacturing, you name it, very good increases in productivity gains. And that's because we can't just throw more bodies at it. So we have to work smarter or with more capital and given enough time with more automation or with more mechanization. So these are things that we're going to have to do over time. And to me, it feels like this is one thing that we're doing right now to be able to get on top of the labor shortages. Now, when you open up the papers that are international, you'll see they're also talking about labor shortages in other countries. In the US and UK, they're talking about massive shortages too, but the reasons are very different. And this chart, I think, shows you very clearly. So this is the number of unemployed people today versus before the pandemic. And essentially what you can see is across most parts of the OECD countries, they have a lot more people who are unemployed today than before the pandemic. Unlike places like New Zealand, which is to the right-hand side in that red bar. So essentially, the reason why places like the UK and US, one reason, is people are just afraid of going to work in places that's going to make you sick and kill you, right? So retail and hospitality is finding it really hard to recruit because you don't want to be working in low pay and in situations where you'll be exposed to COVID and make you sick. And in contrast, in places like New Zealand, we have actually run out of spare labor. So we are going to find it very hard to be able to hire more people or to reduce our labor shortages, even once vaccination is out there, even once we have reduced the risks from the pandemic. So quite different settings. So don't think what you're seeing in media and headlines from the rest of the world applies to New Zealand. Our shortages are far more real and far more biting than other places. And one of the biggest sort of issues for us right now is, of course, net migration was just running so hot for so long that it was one of those it was like a really easy way for us to access skills and talent that we would otherwise not be able to get access to. And you can see on the left-hand side, net migration in that sort of gray line has gone from very, very strong levels to practically zero in the last 12 months. And not only have we seen the net inflow of people essentially stalling, what we're seeing, the people who are already here on short-term visas, particularly work visas and student visas, that's been trending down. So we've lost nearly 70,000 people since the pandemic started. So people who are already here on visas, their visas are expiring or they're going back home for whatever reason, and that population is declining. That means our pool of available labor and available talent is shrinking. So not only is it not growing because people aren't coming in, the people who are already here are also leaving. There was also a big hope that we would see this kind of massive return of New Zealanders, so that brain gain that Liza talked about. And essentially what we saw was, if you look at the kind of left-hand chart, the number of returning Kiwis is around 30,000, which is what we had been experiencing in 2016, 2017, 2018. So it's not that far out of the norm. Of course, 2020 was very disruptive because of the onset of COVID. But yes, there are more Kiwis coming back, but there are big constraints in terms of MIQ facilities, as you know. That means that we can't actually get more people coming back soon. So that sort of return of New Zealanders being that, I guess, the pressure valve for labour hasn't really worked out. And also because the numbers are relatively small. So while we think there is about 600 to 800,000 New Zealanders living overseas, some people say 1 million. We know that most of them are not going to come back because their homes are overseas, their work is overseas, their families are overseas. So New Zealand is not really home for them. The thing that worries me more is less about the returning Kiwis, which I think is, in the scheme of things, a margin of error, is the number of non-New Zealand long-term migrants coming in, generally for work, has fallen from well in excess of 80,000 to now less than 20,000. So we've seen this kind of almost 70 to 80,000 drop in the number of people who are coming in, just adding to our labor pool. And that new flow of new talent and new bodies, that has really kind of turned off. And that is going to make a big difference. And so this is kind of like a little bit of a mental exercise. It's not a forecast. As you know, it's impossible to forecast with the pandemic. But essentially, we started with around 310,000 people who were jobless, not unemployed, jobless. It's like people who were looking and not looking and all those kinds of people. Then when the pandemic hit in the last 18 months, we've lost around 50,000 jobs. We've probably, by the end of 22, we'll probably have somewhere in the order of 145,000, 150,000 New Zealanders who haven't left. But we've also got about 140,000 people who are not coming. There's also probably about 145,000 people who are already in New Zealand who are going to leave. So by the time you get to the end of 2022, we're probably going to have less people who are available to work than we started with before the pandemic. Even if the border opens at the end of 2022, I think the biggest risk for us is the pent-up demand for people to go in the overseas experience. So, there's probably about 175,000 Kiwis who will want to go overseas. And that's a huge number of people. It may not happen in one go, but it means that we're probably going to see quite a large number of relatively young, very valuable workers you've trained up who are doing good work now, who will suddenly go, okay, it's time for me to go to Australia or US or UK or Canada, whatever. And I think the biggest risk for us is, yes, the outflow is something we can't control. We can't stop Kiwis from leaving. But what we do know there's going to be policy response to is how many people can come to New Zealand. That immigration policy, I think, is going to be much tighter. And as a result, we're not going to get 100,000 new migrants coming in once the borders open up. I think the number will be much less. I don't know what that number will be, but my suspicion is it's going to be a hell of a lot less than we have seen in the past. And that means that available pool of labor is going to shrink even more. So we should be preparing for whatever labor shortages you think we have now, for that to worsen as time progresses. And when borders open, it's actually going to make it harder, as long as our policy prescription on immigration remains tight. Now, it doesn't mean we have no choices, right? And I was reading this great book called On Grand Strategy. If you haven't read it, it's quite cool. It kind of traverses all of history and gives you this really nice little vignettes to sort of teach you strategy lessons. And I really like this quote. It goes, "The choices facing us are less often between stark alternatives, good versus evil, for instance, than between good things we can't have simultaneously." And I think that's the strategic decision that we have to make as business leaders and as executives and workers and people, that we can't have everything all at the same time. How do we prioritize to get the best outcome for us? And I think there are a couple of themes here. One is around what can we do at the government policy level and what we can do as individuals and as businesses. And both of those things are important because I don't think they operate in isolation. The first, of course, is around the government, which is the active labor market policies. So we know that there are labor shortages, and the the shortage occupations list for immigration, they need to be really accurate and up to date, which has not been the case in the past. So regardless of what the total amount of inflow is, we need to make sure that it is as accurate as possible. And we should allow limited and temporary visa access while we figure out a way to increase the skills and quality of talent that's available in New Zealand. We need to invest in training and education. So I think our education sector is not doing what our businesses need. They're still very focused on creating academic qualifications and not enough on making business ready and work ready skills. And I think we need a skills fund to retrain workers, because the reality is there are many people out there who are looking for work, but they can't make the switch from where they're at now to where they want to be and where the vacancies are. For businesses, I think there's some very immediate solutions. We have to improve our pay and working conditions. You can see from the survey that beyond it, there are some pretty specific things that workers are looking for. They want flexibility of workplaces. They want career progression. They need mentoring. They need investing. These are things that many businesses don't do well. So being able to not only do them, but to communicate them well to your prospective workers is really important. We can use contractors and temps. Retention, of course, is your kind of the first block of the first cab off the rank. Hiring somebody versus retaining somebody, the difference is somewhere probably in the order of 20% of the salary cost. So it's very expensive to hire someone. So if you can keep someone, it's much better. But really, I think it's really around the long-term plan, around the tasks, attributes, characteristics, job sizing of your business. Having a strong long-term plan of what your business needs and how you're going to do it is going to be really critical. I think we can't assume that there will be any other way of doing things than to invest more in training, more in automation, and far more in digital transformation. We've had a real taste of it with the pandemic so far, but these are the ingredients that will really set us up for the next phase where labor shortages become even tighter. So what happens beyond pandemic? I'll end where I started, which is that pandemic disruptions will continue. The economy will keep growing. There are some risks out there, but the reality is there's lots of policy headroom. We should not be afraid to grow our businesses. Labor shortages will intensify. We have tools in our control. It's really, really important we work as much as we can with the things that are in our control. Thank you.
Thank you, Shamubeel. That very, very insightful and lots of information there. We've got a number of questions, and I don't think that I can feasibly go through all the questions that we've collected, but I'll give it a try and ask a few. I guess top of mind for many people is the vaccinations, and your comment, as people get vaccinated, less social acceptance to social restrictions will occur. But I guess in terms of vaccinations, what difference can reaching, say, an 80% vaccination across New Zealand make to our economy?
The answer is none, because our children are still not vaccinated. So essentially, I think we will see a new variant that will start killing children. So as a result, I think the restrictions that we face today are not going to be gone for a while until we have vaccination that's available to every part of New Zealand. So I think there's a lot of expectation and hope, I think, based on false premises and false hope. There is no magic target where we're not going to be killing people and we're not going to have overrun hospitals. So vaccination is really important for us to feel safe and not get sick. But the reality is there's still going to be a big chunk of our population, not just people who are vaccine hesitant, but in fact, young people and immunocompromised people who simply can't get the vaccine. But I particularly worry about children because politically it's really, really hard to go, we're going to open the damn thing up even if our kids die.
Scary stuff. Very, very scary. And do you believe we'll get to 80% or not?
Oh, look, I think New Zealand probably has far less vaccine hesitancy than other places, but we have a lot of groups, particularly Maori Pacifica, and particularly rural locations where it's going to be much harder to reach. So we got to do things differently. I think, yes, the government's done lots of things right. It's also doing lots of things not so right. And particularly when it comes to vaccines, I think we need to go much more innovative, much harder to get the vaccine out as much as possible. Now, of course, we didn't have enough stock on hand to do that fast enough before. But as that stock comes on hand, we are going to have to really push it out to make sure we protect as many people as possible, particularly those vulnerable communities. I can't, it's quite frustrating for me to watch that we still have people on the front line who are not fully vaccinated. To me, it's extreme.
It is. It's extraordinary. One of the things that you said was that there's winners and losers and not the same, and there's uneven, and it's uneven across the country. Auckland, as one of our major cities, has continued to feel the impact throughout COVID. What insights do you have with regards to the Auckland regional economy? And do you think central government will introduce any boost or any stimulus into Auckland, particularly to boost jobs?
Yeah, look, Auckland has been hit
business.
pretty hard for a couple of reasons. I think one, because of course, we've had more lockdowns than everybody else.
Yeah.
Because we're the biggest place, we're the gateway, this is where the vaccine, the pandemic has happened most. But also because of the structure of the economy. People don't realize that international tourism was, in fact, a very big part of our economy, particularly of the CBD. So that's kind of gone kaput. So that's had a big impact. Retail and hospitality were big parts of the economy. People are working from home more. You spoke very briefly about this, Liza, in the beginning, that the way we work is changing. We're working more flexibly. Great for people to avoid the commute, but not so good for the cafe where you've got, sometimes, 10%, 20%, 30% less customers coming through the week. So there has been much more of an impact in Auckland than you'd expect. But I don't think we're going to get specialized support for Auckland from government. And the reason for that is there is just not that much for love for government when it comes to politics. And it doesn't make sense to take the biggest region, the richest region that has the most resilience, and to go, you should have more support.
Thanks, Shamubeel. Another question here is that referring to the national government previously had policies around capping headcount in the public sector. If they were to win the next election, do you think they would now seek to halt growth in the public sector workforce in general terms?
Yeah, look, I mean, that's a hard question to answer. We don't know what their specific position is, but the national government by and large has been anti-public service. So they've always tried to sort of shrink the size of government. And part of the reason I think why we are having some difficulty, relatively speaking, when it comes to the COVID response, because we didn't have a proper pandemic plan. And our ICUs are underfunded, our health sector is underfunded, which was pretty much all done under national, because there are people who don't like to pay taxes and don't like to fund public services. So there are some real, I think the pandemic has shown us both sides, that you don't want to be wasteful, but actually there are some necessary things that we need for things to work. Now, I think by and large, I think we can assume if there is a national government, Wellington, which has been an absolute tear since the Labour government came on board, is going to be hit really hard. We know that they don't like public servants, they don't like government departments, and as a result, I think there will be a hiring freeze. I think it'll be wonderful for people who can go consulting, but by and large, it's pretty hard for the Wellington economy when there is a national party in charge.
Thanks, Shamubeel. Another question here, again related to government. Successive governments have tried to reduce the use of contractors and gig workers as a blunt cost savings approach. Given the worsening supply of skills, do you see that in the main that will continue, or do you think the government will embrace a more flexible workforce as part of what we need to do to ensure we tackle the talent shortages that we're experiencing?
Yeah, look, I mean, as you know, it's a double-edged sword, right? With contractors, you get access to relatively good skills, but at higher cost. But without the responsibilities of managing somebody, right? But also with the cost of not having them in your team, part of the culture and all those things. So there's a lot of to's and fro's when it comes to use of contractors and temps. What we're seeing is kind of almost I don't know what's the right word, schizophrenic approach from many government departments. They want contractors, but at the same time, they don't want them. So they'll use them for a while and they go, oh, if you want to keep working here, you have to become an employee. Well, that's actually not working in good faith, is it? So if I look forward, I think the use of contractors is going to be something that we'll see more of, because when there are extreme labor shortages, those extremely talented people will be able to get more work, make more money, and do more work as contractors than as employees. So I think it's inevitable, but not everybody has the constitution to be a contractor or to be a freelancer. So it comes with a lot of risks and responsibilities. So, it's a fairly cagey answer, because I think there is not a right answer for every person or for in every business.
For every sector as well. Back to housing, your favorite topic. What advice do you have here for first-time home buyers versus baby boomers, given more and more locations are getting hostile and it's getting harder and harder to afford, that first home or get into the house that you're wanting to get into?
Yeah, look, there's no good advice to give, right? When house prices have increased by 30%, it's very hard to actually save the deposit. So even the mortgage rates are very cheap, it's very difficult. So if you're not lucky enough to have parents that can help you with a deposit, or to put you up for a while to not pay rent and save money, unfortunately, I think your best option is to go to places like Australia, where your income will be higher and house prices and rents are cheaper. Sadly, that is going to be the reality of many young New Zealanders going forward. You're better off not being here.
Thanks, Shamubeel. We're starting to run out of time, and so just one last key question. 3 key pieces of advice you can give business leaders or owners and organizations as we navigate through and traverse through COVID-19.
Yeah, it's a hard one. I think the big one for me is, don't expect others to bail you out. I think you have to take charge of your destiny. So we know what the situation is, that there is business to be done if you're prepared and you have the capacity, but it's not going to be handed to you on a silver platter. If anything, there's going to be a lot of volatility. My advice would be to have a plan that is very long term, so you have a very clear idea of what is it that you want to achieve, but also a plan that is extremely flexible, so you can pivot with the big changes and uncertainty that we're seeing right now. Invest in your people, invest in your people, invest in your people. Without your people, you're nothing. And I think that's the mistake that we have made in a lot of businesses over the last 30 years, where we knew that there would be somebody out there who would be able to fill those gaps. I don't think we can assume that any further going forward. So I know you asked for 3, but there is really only 1. It's invest in your business and invest in your people. It's the only thing that works.
Very sound advice. Thank you, Shamubeel. As always, you've certainly provided us with really good insights and lots of takeaways. I know that I've taken a lot away from this session. On that note, I'd like to close the webinar. On behalf of Beyond Recruitment, I'd like to thank you all for joining this webinar. This webinar has been recorded for those of you that have not been able to listen to the whole webinar, and we will send you a copy together with a copy of our 2021 and 22 Beyond Economic and Labour report and our updated and current salary guideline. Once again, a huge thanks to all our respondents for completing the survey. As a gesture of goodwill, we are electing to give back to the community rather than give out prizes for participation. We're putting your names into a hat to draw 4 respondents, 2 in Auckland and 2 in Wellington. If your name gets drawn, you will have the opportunity to donate an amount of $500 each on behalf of SAF to one of the following charities. These charities include the Cancer Society, the Heart Foundation, Kids Can, SPCA, Kiwis for Kiwis, Auckland City Mission, St. John's, Starship, and the Muscular Dystrophy New Zealand. We will announce the 4 lucky people in the next week. Thank you for joining, and we wish you a safe level 2 as of tomorrow and level 4 lockdown in Auckland. And thanks again, Shamubeel. We value your insights. Thank you.